So Singapore's the latest in a line of Southeast Asian countries which have introduced new tax rules which, broadly speaking, make the country slightly less tax friendly, particularly for those who have foreign income, foreign investments. And, this is aligned with what's happening elsewhere in Southeast Asia. Think very controversially, Thailand's introduced new rules regarding remittances, and we've also got Malaysia that have recently introduced new laws regarding foreign sourced income. And so generally what we are seeing is a slightly less favourable landscape in Southeast Asia when it comes to taxes as a whole. And naturally a lot of people have been worried about this, even folk that perhaps aren't actually affected by the latest rule changes have been asked a lot, is this, just the start of things to come? Is there more things on the way? Because it seems, every month now we get a new change that someone's introduced, and basically just makes the broader tax landscape just, worse off for most taxpayers. So just to get into, high level overview of basically what's happening in the global tax landscape, without getting into too much technical detail as to the specifics in some of these countries, generally speaking, there is a global pressure being led from the OECD, which is generally a club made up of the richest countries in the world. Specifically, it's the US, the UK, and a lot of European Union countries. They've had proposals and real plans to introduce higher taxation across the world for a long time, because they don't like the tax arbitrage opportunities that people have taken advantage of over the years. The fact that lower tax jurisdictions, tax havens, attract a lot of the potential tax base that these larger countries see that they could be actually getting access to. So it's been a long time coming that changes to the kind of global tax landscape were not only just being proposed but introduced, and unfortunately we are seeing these things being introduced now. So whilst at the moment we're not seeing too much kind of draconian rules introduced on individuals and small businesses, we are seeing small changes, like I said, in Thailand, but what we are seeing globally is that there is a minimum tax come into play. As of 2025, a lot of countries have signed up to this global minimum taxation, meaning that if there is a global multinational operating and they're paying less than 15% taxes overall, then they can be basically topping that income up to basically pay a global 15% minimum tax. Now, for the moment, this is only going to apply to huge multinationals, so 9-figure revenue companies plus. So at the moment, these new rules are not going to affect the average person and small business owners, but it does signal the direction of travel. They are broadly introducing stricter rules and regulations, and they are trying to flatten out the kind of global landscape. So whilst these kind of global minimum tax rules are hitting the kind of larger organizations, and you're not going to hit the common man yet, the likes of the rule change in Thailand and the foreign exemptions that are closing off in Malaysia are showing that these are kind of gradually almost dripping down to the bottom end of the tier as well, and these countries are under pressure just generally to kind of more align their tax systems with the rest of the world, and just kind of close off some of the advantages that used to exist. So in terms of the kind of short to medium term, I still wouldn't be concerned in most people's cases for now, because like I said, small rule changes are happening, but they're not too drastic. I think a lot of people have been very upset by the Thailand changes, but I don't think they're as kind of draconian or terrifying as people are making out. There's still a lot of ways to live a pretty tax-friendly lifestyle there. And in general, a lot of these changes are just going to hit, large businesses for now, but it's more when we bring into play the kind of wider financial landscape and monetary landscape. That's what kind of concerns me more for the future, and I would say specifically with regards to central bank digital currencies, because whilst at the moment, like I said, they are really targeting huge multinationals, Once the kind of central bank digital currencies come into play, then that gives them a much broader scope and ability to kind of bring individuals back into the tax base. And so this would probably concern me a little bit more. Let's take the example of, if I'm from the UK and I've left and I've set up a relatively tax-friendly lifestyle, maybe, living in a tax-friendly country with a tax-friendly jurisdiction company registered. Who knows, in a few years down the line, the UK might be like, well, you've still got your bank account back home, you use the digital pound, and as a result, we're going to tax your income at a flat rate of, let's say, 15% global minimum, something to that degree. I'm not saying that's going to happen, but it just feels that, throughout history, this is the kind of strategy governments have used, because if we look back on the income tax history, that was initially just meant to be, a temporary measure post-war. But of course, we all know what happened there. Effectively, that led to, pretty strong increases and eventually, permanent income taxes. And so the same could apply here. That's what I'd be more cautious of, is, they're drip feeding, minimum taxes into the large organisations. How long will it take before it's kind of smaller businesses and then eventually individuals? I wouldn't be concerned for the next few years, because, like I said, these current rules and new minimum taxes have taken a long time to take effect and get implemented in a lot of countries. So it might similarly take a long time to get implemented at an individual level or small business level, but the direction of travel is potentially worrying. And again, if you combine it with the CBDCs and all of this, kind of new global landscape with the common reporting standard, which integrates a lot of kind of bank reporting and sharing of data between governments, it just all aligns with a little bit of a concern with regards to what is the landscape going to look like by, let's say, 2030, when there are predictions for the CBDCs to be enforced. So yeah, I mean, I would say, just going back to Southeast Asia, really these changes are often driven by an increase in pressure from external sources, and particularly the OECD, the US, the UK, European Union. That doesn't mean that every single rule change that they put into place is purely driven by this. There might just be a genuine concern about their own tax base. Maybe they do want to increase their tax take, but it does align with flattening global taxation and kind of coming more into line with other countries, and not stepping out of line to the degree that they're perhaps used to. So my key takeaway would just be that next few years, I wouldn't be too worried about the landscape, on a small business or individual level, in terms of, these kind of global minimum taxation rules or anything to that degree, because, as of yet, we don't know, what's happening behind the scenes, but as of yet, there's no proposals for any of that to happen. But of course, people are naturally worried, because they are seeing, the likes of Thailand, Malaysia, introducing a little bit stricter and slightly less tax-friendly rules. But then there's also the flip side to keep in mind, that countries might have genuine reasons to be raising their tax base as well. So I mean, of course there can be global pressures, and we've seen global pressures significantly impact the Caribbean tax havens in the past. They have had to change a lot of their rules. They've brought in economic substance rules and things to that degree. So of course global pressures can impact countries, but sometimes it is just a case that the country is actually legitimately just wanting to raise its tax base. So we can't ever say for sure what the key motive is, but countries do have their own autonomy, and you just never know. It might just be a genuine concern about taxes that they can raise. But yeah, next few years I just wouldn't be too concerned then on the kind of global enforcement and sort of OECD plans to really flatten tax for individuals or small businesses. But as I said, 2030 onwards, at the time when it's more likely that CBDCs might come into force, that's maybe when I'd be more concerned and more, I guess, cognizant of potential changes, and I'll just keep informed or keep on top of the the kind of landscape, because again, individuals can still make a difference. You can still make your voice heard as and when the time comes. Hopefully, if you do see some draconian rules coming into force in the future, we can at least do something to try and kind of prevent these. I don't think we're totally powerless in that regard. So yeah, short to medium term, really, I wouldn't be too concerned for individuals and small businesses, but yeah, it's just something to keep aware of. The global landscape is changing. It's changing rapidly, and you just never know where we're going to be in the following decade. So I mean, hopefully this was a useful overview. I'm sure there'll be a lot of opinions on this. It is quite a controversial topic. If you've got any thoughts on what's going on, or the kind of general landscape, or you've got any questions, just give me a shout in the comments section below. Cheers.